When revenue expenditures are not regarded as revenue expenditures. When revenue expenditures are not regarded as revenue expenditures, there are some items of expenditure which are revenue by nature, yet they are not regarded as revenue expenditure. Such expenditures may be divided into two groups. One, deferred revenue expenditure. This is a revenue expenditure, the benefit of which is not confined to one accounting year. It extends to future accounting years or years also. However, this expenditure does not result in the acquisition of any fixed asset. For example, heavy advertisement expenditure is incurred on introduction of a new product in the market. This is revenue expenditure in nature, and the benefit is enjoyed by the business over a number of years, but no asset of permanent nature is acquired. A portion of this expenditure is treated as revenue expenditure chargeable in the current accounting year, and the remaining portion is temporarily treated as capital expenditure and shown on the asset side of the balance sheet. Examples of deferred expenditure: a expenditure incurred to the formation of a joint stock company, preliminary expenses, expenditures on research and experiment connected with the introduction of a new product, heavy advertisements for making a new product, heavy expenditures on repair to property, expenditures on removal of business from one place to another place. 2. Capitalized expenditures. Some expenditures, although of revenue nature, basically are directly connected with fixed assets and spent directly on the acquisition of fixed assets. Such expenditures are added to the cost of assets and are called capitalized expenditures. For example, we buy a second-hand plant for Rs 50,000. This is undoubtedly a capital expenditure. A further sum of Rs 5,000 is spent on its repair and overhauling in order to bring the plant into proper working order. Expenditures on account of repair and overhauling, although are revenue by nature, will be treated as capital expenditure in this case and will be debited to plant account, not to repair account. Thus, a revenue expenditure which increases the utility or productivity capacity of an asset is treated as capitalized expenditure. Example: expenditures on installation and asset. B. Expenditures on repair to property. If the production capacity or utility of the property is increased, it may however be noted that sometimes a new asset may require some repair after its purchase, but before it is installed and put into operation. Cost of such repair, although it may not increase the production capacity of the assets, will be treated as capitalized expenditure. See, expenditure incidental to purchase of fixed assets, for example, freight, clearing charges, custom duty, carriage, octroi duty, import duty on assets purchased. Expenditures on removal of a old property. Cost of repair to second-hand asset. Repair is a revenue expenditure, but the cost of repair after buying a second-hand asset to bring them into proper working condition is treated as capitalized expenditure. Wages, it is revenue expenditure, but if paid for installation of a machine or plant, then it is treated as capitalized expenditure. Legal charges, for example, lawyer's fees, court fee, in connection with the purchase of assets of permanent nature are regarded as capital expenditure. Interest. Interest paid is generally a revenue expenditure, but in some industrial like iron and steel, cement industry, a concern has to wait for a long period before it starts operation. Interest for such period on capital and loan is treated as capital expenditure.